Good morning and welcome to the May end of month market update. I've been slightly delayed this month because I was caught up in a lot of things, but finally here we are. Uh, what I want to cover in this month's end of month content is the usual three things that I look at: the Nifty valuations, the system liquidity, and the interest rates, and what's the trajectory looking like. Uh, One new thing that I've covered before, but I just want to touch upon once again is the FII investment tracking. How have been the FIIs doing? Uh, what reforms are needed for FIIs to return back to India and start investing back in the economy? What I am investing into. These are some old names that I have invested into uh, in my portfolio, and a look at how is the market breadth looking like after a complete month has passed out. So if we look at the Nifty valuations, we are somewhere at around 20.37, which is again, if you see, well below the median line, right? This, as I've said multiple times in the months, these months that you have seen where the Nifty P valuations are below the median lines have been months to search for fantastic and quality stocks to invest into. And if someone has capitalized on that, you would see your portfolio to be less volatile as compared to people investing in these zones of valuations, right? This is where people will see that immediately when Nifty falls, their their portfolios are significantly falling. So once again, this zone in 2023, this 24, this is 25, this is in 26. All these have been locations of investing in quality stocks. Investing, and when I say quality, I'm not talking about any small cap stocks. I'm only looking at large cap and mid caps at best, right? So I'm still looking for opportunities across various sectors. I'm still looking for leaders in various sectors. As long as the Nifty P is below the median line, the long term, the all time median line, right? Now, as I've said in the previous videos also, that the system liquidity, there were two choices that the Reserve Bank had. One, increase the interest rates, or second, reduce the liquidity from the system, right? Which will in turn control inflation. The harsher way of controlling inflation is simply hike the interest rates, and then the entire economy goes into a credit cycle, which is going to cripple the overall growth. So I think RBI has done a very smart thing by starting to reduce the liquidity, and you can see this on the chart. I was talking about reducing liquidity, tightening liquidity long back in Jan and Feb, and now you're slowly seeing that the Indian central bank's balance sheet is starting to tighten here, which means that they are giving back the bonds in the market and collecting back the rupee uh, that is against those bonds in terms of value, and then pulling that rupee out of the system to make sure that less funds are available and people are able to spend less for a while, and there is just less liquidity in the overall system. And this is a very good move. It is much better than increasing the interest rates. Now, what will transpire from this is the interest rates have been stable, and we have stuck to around 5.25 from a really long time. Now, what's going to really make difference is how the rainfall for this year turns out to be. If the rainfall is not great, we're going to have a lot of inflation hike, because food prices is what adds into our inflation with a very high weightage. So a low rainfall for the year would mean a lot of trouble. We are already hearing things about El Nino and all of the other things that are going on. But irrespective of that, rather than predicting the rainfall, once the season is over, it will be very clear of, have we got enough rainfall this year? Are we going to get a good harvest? after the rainfall season is over, that's something that will drive the interest rate decision predominantly. Now, the global factors have eased, the wars have eased, so we can ignore those factors as of now, but the domestic factors still remain uh, consistently important, which they have always been. So the interest rate trajectory will depend a lot on how the weather turns out, how the rainfall turns out this year. Now, we keep talking about the retail investors are holding the Indian market, and um, everything that a certain person in the government comes and says a lot of times that we don't depend on FIs anymore. Uh, See, if we would have not depended on FIs anymore, and if the retail money is good enough, why is the retail money not able to take the Nifty index higher? Right? A very simple thing to look at. So it is us against the world economy's money. And you cannot ever beat that with retail participation. It's very clear. The role for DII is very simple, that they have to hold the market. And the role for DI is also very clear, that they have to hold the market, particularly for stocks that are important to the economy, the companies that are important to the economy. A small cap, which is 100 crore, 200 crore micro cap, DIIs have no interest in holding the prices of those. DIIs will put interest in a Titan, a Tata Consultancy, a Schaeffler India, right? That's where the money will be deployed, because they also have limited capital. And we all need to understand that if FIs don't return by giving them good reforms, things can go flat or even south for Nifty for a significant period of time. So, and I think the government has started to recognize that slowly. They have done some taxation changes in the capital gains from the bond market. They're trying to do the same in the equity market. And if that turns out to be true, then there's going to be a heavy inflow of FII investments in India. The only thing we are looking for is to recognize. Now, all the blue lines that you see here, they are all FIs. So if you see the entire previous 12 months, the FIs have bought only 1 month at best, and that to a very minor quantity with in comparison to what they have sold here, here, and here the past 4 months. So if you still believe that the retail money is holding the Indian markets up, rethink about it, look at the data, don't be fooled by statements that come out by various entities. You have to look at the data and understand what is exactly going on. Now, there was a very interesting report uh, by Bernstein, which is a very strong and a very big brokerage house in the States. And they came up with a few things, a few recommendations for India in terms of reforms to return the FI money back to India as an economy. So, a few things, and I don't agree with every single point that they say, but a few things are very important, which are uh, very crucial to the economy, and which are very crucial to the overall growth and the overall infrastructure build that we have as well. So one of the first one is what they're saying in terms of artificial intelligence and technology. They are saying that India is becoming a consumer of AI rather than a creator. So India needs to build infra, India needs to build models of its own, and needs to strengthen its AI and technology and reduce the dependency on foreign models. Manufacturing has been a weak point for us from a really long time. China has surpassed us in almost every single sector. They are able to produce things at a much cheaper price than us. They're able to produce things at a much faster rate than us. So uh, India is being asked to go into emerging sectors such as advanced materials, robotics, and automation. Uh, what the Bernstein is also saying is agricultural revamp is important, because agriculture still employs 42 to 45% of the workforce, but is only contributing 15 to 18% of to the GDP, right? Uh, the report demands a shift away from recurring input subsidies uh, and loan waivers in favor of improved irrigation, better logistics, and income-based support, which even I agree that we don't need subsidies, we need water to reach the farmers at the right time when they have problems with rainfall, when they don't have enough irrigated water. Those are the things that we need to work on rather than giving them subsidies when their crops go bad, giving them insurance policies when their crops go bad, right? Infrastructure once again is being carried out, that unconditional cash transfer schemes are crowding out crucial capital infrastructure. So infrastructure growth is important. Again, we have a very heavy reliance on imported crude oil, leaving India vulnerable to price shocks. Now we are seeing news about E20, E85. I don't know if there will ever be a E100 and whatever is going on. Again, I don't agree with the fuel that has been replaced uh, for a variety of reasons. It's a very long topic for this video to be covered, but we have to look at ways to be able to buy crude oil with our own currency rather than doing it in USD. That's the key to ensuring that we are able to fund our own import bills without relying on the exchange rate with the United States dollars. Instead of coming up with fuels that have absolutely, um, I would say, absolutely no bearing to work in the long term. So, energy independence is very important. We should be able to generate our own cheap electricity. We should be able to generate our own energy resources. We should be at least able to buy our own energy requirements in our own currency. That's a very important point for us to move forward. And of course, R&D lacks in India. It's been seen across. You don't see R&D fundings across. One of the personal recommendations that I have for FPIs and FIs to return is ease the LTCG and STCG tax on capital gains. Forget the retailers, at least ease it out for FIIs and FPIs to return back to India. There is no incentive better than an incentive where there are lower taxes in a country which is expected to grow at a very fast rate in the near, at least for the next couple of decades. So that's what FIs need. What am I investing into? I always speak about this. I'm investing into companies that are above 10,000 crore market cap at least, that have a competitive moat in their respective sectors. So if you see LIC Housing Finance, Bharti Airtel, strongest uh, in the telecom sector. I've bought a few ETFs recently in February, and I'm speaking about it now because I can only speak about stocks that I've bought 3 months later than what I've bought. Uh, all silver Bs that I exited in February booked about 160% profits on my investments. You can follow me here on Follow My Portfolio if you want. It's a paid service where I put in the stocks that I buy for my own journaling. This is not a recommendation to buy or sell, but I do make notes of what I invest into and when I invest them into and when I exit them as well, and for what reasons. In terms of the market breadth, we were looking at the number of stocks in the range of 10,000 crore and above. What has been the improvement? So if we see from February, we were about only 23% of the stocks were about 200 DMA, which improved to 27 in March, which improved to about 55% in April. And now in May, it is close to 54%. So we are just above the 50%. So in a very, very bullish market, you will see 80% of the stock above 200 DMA, right? But these are improvement areas. These are the times when things are improving. And these are the times when nobody wants to invest. And these are the times when those are the best times to invest. So I'll try and make another update for the June month in once we are there, or probably in the first to second week of June, and let's see how things improve by then. Uh, Key pointers to note: FIs need to return back to the Indian markets. We need to make sure that we are giving them enough incentives. We need to ensure that our energy reliance is being worked upon in the long term. We need to be able to buy our own energy supplies from outside in Indian rupees. And we need to be able to invest in stocks when the Nifty's P is below the overall all-time median P. I think following this much can create a very long or a very strong long-term portfolio for someone who is willing to keep this money invested for 5 to 7 years. And that can literally grow the portfolio to a very good extent if things are done right. With that, this is all that I had to cover in this month end update. Until I see you next time, thank you very much and stay safe. Bye.